Hey everyone. So it's getting to be that time of year where people may start thinking about their annual taxes. Maybe it's a little early, but also people start hopefully thinking about the potential of getting a annual raise as well. And there's a really common myth or misconception out there in kind of the world that I run into when I talk to certain people, and I wanted to hopefully illustrate and clear that up. Now, listen, I'm not a tax professional, and you should have your taxes done by a tax professional. This is not financial advice in any way. I just want to explain how the IRS graduated tax system works. So let's get started. And this is straight from NerdWallet, and I think this contributes sort of to the confusion when people see the tax rates laid out like this. These are the 2023 tax rates, and when you look at this, you think the kind of misunderstanding that I hear from folks, and I'm going to use the married filing jointly numbers just because they are a good illustration of where this point of confusion comes from, especially here where the numbers go from 12% to 22%. So a lot of times people think, oh, my spouse and I are making $89,450. If I get a raise above that, let's say you're fortunate enough to get a bump up to $100,000, those are the numbers I'm going to be using for my figures here. You think, oh, well, that's actually going to be worse. I'm going to be worse off because now I'm going to have to pay 22% taxes instead of 12. And the small bump in pay relative to where I am now is not going to be worth it. It's going to be offset. And people say, now where it is true, the more you make, the more they take, but it is not a flat tax rate. It's a graduated tax rate system. So what does that mean? That means right now, if you're earning $89,450 and you think you're paying a flat 12% tax, that actually isn't true, right? Because there's actually a bracket below that. It's a graduated system. So the perception at $89,450 is that you're paying $10,734, but the actual, if you read what this is saying, and this I'll show you a better representation of this. This I feel like is really confusing and kind of perpetuates that myth that it's like the more you come up here, the bigger your tax rate is, and this number isn't applied uniformly to all the dollars all the way back to zero. Better representation is actually this one from Forbes, and hopefully you can read that okay, where it sort of display this in a way that shows the graduated tax system a little bit better. We're going to take a look at this. If you're at $89,450, you're actually not paying 12%. Your actual tax is $10,294. Now, not a huge difference. You're not paying a flat 12% on $89,450. You're paying $2,200 plus 12% on the amount over $22,000 because it's a graduated system. This will get a little clearer in our next example when this big jump happens. If you were to get income above $89,450, let's say $100,000, the perception is you jump up to 22% tax. And what is 22% tax? So that would be, well, 22% of $100,000, which is $22,000, and that seems like a pretty serious jump. But the actual tax, because it's a graduated system, is actually only $12,615. Now, how did I get that? Let me show you that formula again. What the graduated tax system is saying is when you get above 100, as you go up each bracket, you have to pay for the amounts over the brackets below it. So lo and behold, when you were making $89,450, it just so happens that you were paying exactly $10,294. Would you look at that? And then when you started earning money above 89,450, so your 89,450 first dollar is then taxed at 22% and onward. And so what you're actually paying for taxes is the taxes of the bracket below plus 22% of the dollars above 89,450. Still confusing, I know. So let's look at this another way. Here's our $100,000, and you're paying taxes in chunks. How did I get to this 12,615 number? If this formula isn't making sense to you, we'll look at it in a way over here, like this, which is from $0 to $22,000, you have to pay a flat 10%. This is for a married filing joint, right? This is a flat tax. From 0 to 22K, it's 10%. There's no levels under it. Now, I'm not talking about deductions and all that other stuff. I'm just talking about explaining the graduated tax system. For the dollars above 22,000, so the 22,000 and first dollar, all the way up to 89,450, which just so happens to be the next $67,450, you're paying 12% of these dollars, which ends up being 89,004. You don't pay 12% all the way back to 0. You pay 12% on these dollars, 10% on these dollars, and it accumulates up the higher you go. So now, if your pay goes to 100, you're paying 22% tax only on the dollars above 89,450, right? So what's that? It's $10,550, and that tax is $2,321. When you total all these things up together, you get $12,615. So I hope that helps. If it doesn't, for people who prefer a bit more of a visual demonstration, let's look at it this way. Let's imagine this green bar here is $100,000. You're only paying 10% on dollars 0 to 22,000. After that, you move into the next bracket and you pay 12% on dollars 22,001 to 89,450. If you keep earning more, you pay 22% on these dollars above 89,451, all the way to your 100K. Now this bracket actually goes all the way up to 197.50, but we're talking about, you know, a couple that earns 100,000 for this example. So if you surpass, if you're lucky enough to surpass $190,750, now you jump up to the next bracket, which would be 24%. And on you go up. This number doesn't get applied all the way back to $0. It's in chunks. You pay for this piece. When you cross over, you pay a higher rate until you cross over, and then you pay a higher rate only on the dollars that have crossed that bracket. I hope that makes more sense, right? Only on these dollars. The minute you cross over, you're only paying taxes on. So you're only paying 22% on these dollars, which, as we saw over here, is only the last 10,000. Above 10,550, that's above 89,450. So I hope that helps. And here's another visualization too, where you can see it steps. Here's your 10%, then you're done. You've already paid 10% on this 22K. You don't pay taxes on that. You start at 2201 to 67,450, and you pay 12%. After that, you're done paying taxes for those dollars. Next, as you go to 89,451 all the way up to 100, now you're paying 22% just on those dollars. And on it goes up the brackets. So I feel like this is a much better representation. And lo and behold, these dollars are this number here, this 10,294 is actually the full tax of 89,450, just like 2,200 is the full 10% of 22,000. So it sort of snowballs. Now, I also hear a lot of people saying like, oh, well, this is complex, a flat tax system would be better. It maybe would be simpler. I don't know if it would be cheaper, as we see here, even here. This would be a higher tax, and certainly here this would be a higher tax. So it might work if it were a much simpler and much lower rate than maybe. Right now, this is about roughly 12% of 100,000. So I hope that clears this up a little bit. I'm probably crap at explaining this, but I really tried to show it a few different ways. That's the nutshell of what I wanted to communicate. I hope that helps some folks. I have a couple other interesting spreadsheets I want to go over in my next videos. I'll be covering kind of how loans and mortgage amortization works, and maybe a couple of techniques you can use to get your bill down quicker. And so keep an eye out for that. Hope that was helpful to someone, and thanks for watching.